What's up, everybody? So if you are here, congrats, you found it. No, just kidding. Congrats, you are most likely buying a house or you are refinancing to save some money. That's right, you're a big kid now. You're going to have a mortgage. You are trying to buy a house. You are doing big things like refinancing. So the question is how to structure it. Which one is better, 15 years or 30 years worth of bondage? Oh, did I say bondage? I meant mortgage. So this video is going to break down how to make that decision, how to decide between a 15-year mortgage and a 30-year mortgage. I'm going to discuss the pros to each and the cons to each, as well as explain how you can decide and how you can run numbers through an Excel amortization spreadsheet. That's just a fancy word for showing you how many payments you're going to have, as well as how much total interest you're going to pay. So you're going to learn how to run all of those numbers yourself to help you decide with numbers which one is better, a 15-year mortgage or the 30-year mortgage. Because I'm a numbers nerd, I like to look at the numbers, and so that is why we're going to go through the Excel. That way you can see the numbers for yourself and be able to decide with numbers which one is better. Numbers. Lots of numbers. My name is Greg Acton. If you want to get better with your personal finances, if you want to develop more streams of passive income, consider subscribing. Now let's get right back to the content. All right, before we jump into the Excel and see the numbers, let's talk about a few other things to consider when deciding what mortgage you want. Like the first thing, you could think about your age. Like if right now, if I got a 30-year mortgage, I'm 31, so I would be over 60 years old if it took me the entire 30 years. So I have a whole nother lifetime, a whole nother time space. As long as I've lived already on earth, I would have a whole nother lifetime of paying down a mortgage. And that's brutal to think about. But seriously, you're going to want to think about your financial goals. Like, do you want to retire early? It's kind of hard to retire early if you are paying down a mortgage constantly. You got to think of the size of the payment, or what I like to say is cash flow, because I think cash flow is the most important thing to think of when you are either buying real estate for yourself or as an investment property. Cash flow. So are you going to be positive cash flow, or is this something that's going to be negative cash flow? Obviously, if it is negative cash flow, meaning you don't have enough income to cover the payments, bad choice, don't do it. And then there's things like interest rate differences. So you can have higher interest rates, lower interest rates. Obviously, your credit can affect that. So you need to consider your interest rate as well. So without further ado, we're actually going to jump into my current mortgage, and I am looking to refinance because interest rates have plummeted because of all of this stuff going on in 2020. So I am looking to refinance it to a 15-year mortgage. I'm currently on a 30-year mortgage. So let's jump to Excel, and I'm going to show you my mortgage specifically. All right, so I'm sitting at my computer now. Let's jump right in. Okay, so if you haven't ever done this, you need to open up Excel. So I'm opening up Excel right now, and then they have these templates that are free. So you can find a loan amortization schedule and create that template. Okay, now it's pretty easy. So obviously the loan amount, that is the amount that you're financing. So when I bought my house, I bought it for $203,000. So I put that in there. My interest rate was 3.99%. My loan period in years, so I'm going to put in my 30-year mortgage. I have 12 payments per year, and I did this in January of 2020, so pretty recent. And then optional extra payments. This is just for fun to see, how your interest rate changes, or not your interest rate, your total interest payment changes over the total life of your loan if you make an extra payment. But we're going to put that at 0. Okay, so scheduled payments. It tells you how much you are going to have to pay every single month. Obviously, scheduled number of payments is 360. That's 30 years times a 12-year mortgage, so that's 360. Actual number of payments. This can change if you add an extra $100. See, it changes from 360 to 302. We're going to put that to 0. So something fun that I like to do, I like to put in an extra calculation and say, hey, 360 divided by 12. That's just obviously 30 years. right there. But if you change this and say, I am going to pay an extra $100 a month, you'll see it actually drops to 25 years. So side note, doesn't really have to do with the whole refinancing thing, but it is a cool tool to show you if you make extra payments, what would happen. And obviously you can see it would rock. You're going to have a lot less time in bondage, like I said before, and in your mortgage. Your 30-year mortgage would drop to a 25-year mortgage. So another cool thing it shows you is your total interest. Insane amount of interest, right? So on a $203,000 house, you're going to be paying $145,000 in interest. So if you add those two together, it is $348,000 that you're paying for a $203,000 house. So things to remember. But like I said, if you add $100 a month extra, it drops to $118 instead of, that $145,000. So what I'm going to do for the sake of this argument, I have a 30-year mortgage. This is my actual mortgage. This is what I am paying on. So I'm going to type in 145,437 right there. So that is the interest that I would pay right here. I just put it over here just for a comparison on my 30-year mortgage. Now, I'm looking at refinancing because interest rates are extremely low. So I can refinance. There is some closing costs every time you buy a house, and that's things like an appraisal, title, insurance. You have to prepay a little bit on your mortgage, but not much as far as like one extra payment. Obviously, you have to put 20% down if you want to avoid mortgage insurance, but I can refinance. If I refinance, my loan will go up to $205,000, and that's because I would be financing my closing costs. So it jumps to $205,000. Now my interest rate, because it is a 15-year mortgage, my interest rate is going to go way down. So I am going to actually get a 2.625 interest rate, which is extremely low. That is insanely low. So 2.625, and I'm going to do, instead of 30 years loan year period in years, I'm going to do 15 years, and obviously it's still 12. The start date would be now, it'd probably be like August of 2020. And now if you can see over here, my scheduled payment before it was like $980, and now it is $1,379. So there is a big difference there. So I'm going to just show the difference. The difference is right around $400. But if you also see this total interest, so if I pay the entire 15 years, my total interest is going to be $43,000. Now, if I paid the entire 30 years, my interest would have been $145,000. So there is a giant difference when you look at the total interest. So I would have interest savings. Oh, that's the wrong button. Let's get that back to black. Now, I'd have total interest savings of $102,000. So there is a huge difference between a 15-year mortgage and a 30-year mortgage as far as what you're going to be paying with interest. A lot of that is just due to the shorter term. So instead of paying for 30 years, obviously you're going to cut that in half and pay in 15 years. So your interest rate is not going to be compounding as long, but still compounds over those 15 years. You're still always being charged interest on the outstanding balance of your loan, but instead of drawing that out over 30 years at a higher interest rate, you're actually drawing it out over 15 years on a lower interest rate, which rocks. All right, so let's go over a few of the pros and the cons to having a 30-year mortgage, and then we will go over the pros and cons for a 15-year mortgage. So obviously one of the pros for a 30-year mortgage is explained just barely with that Excel template, is you have a lower payment, which is nice. You have more cash flow that is free during the month. So in my instance, if I kept my 30-year mortgage, I would have an extra $400 in cash flow that is free. It's not tied down into a mortgage. I like this because it gives me the flexibility. Obviously, I can take that $400 and pay down the loan quicker, and it does save me interest, not near as much interest as switching to the 15-year mortgage with the lower interest rate, But if I ever got in a bind, I could say, hey, I'm not going to pay extra on my mortgage. I'm going to keep that extra $400 and I'm going to use it for something different. And this is nice if you have an investment that is making you more money than you would be saving on interest. So you could take that $400 and maybe invest into a rental property. And if that rental property ends up making you more money, you could take that money and go and pay your mortgage down even quicker. So there is better options. There can be better options to take that $400 and maybe invest it and make a return. So I think that's the biggest pro. Obviously the cons are a long term. So yeah, you have 30 years worth of a mortgage, which is a long time. And then obviously you have the higher interest rate as compared to the 15-year mortgage. All right, so 15-year mortgage, pros and cons, it's pretty much the exact opposite of the 30 years. So where my negatives on the 30 year are my positives with my 15 years. So I have a lower interest rate and I have a shorter term. Obviously that can save me money with interest over the life of a loan. But the 15-year mortgage cons are the fact that you have a higher interest or a higher payment. So you are going to be paying more each month. And in my example, it's $400. So I will have $400 more going onto my mortgage, which restricts my cash flow. I can't take that money and invest it. I have to pay my scheduled payments on my mortgage, so I have a higher payment. I hope that helps you out deciding whether or not you want to do a 15-year mortgage or you want to do a 30-year mortgage. Just a few tips as far as when you are deciding. I am a cash flow person. I just always think in cash flow. So if my cash flow cannot handle a certain term or a certain interest rate, there's just no way I'm going to do it. And I actually like to give myself a lot of cushion. So that's one of my biggest tips when getting a mortgage is don't over leverage. You might be tempted to get a nicer house or to get a bigger house or more expensive, whatever it is, but just make sure you look at your income and don't over leverage, because the last thing you want to do is to be house poor. That means all of your money is going to your house and you don't have any other money to invest, to go on vacations, to enjoy with your family. Don't be house poor. And then another big tip that I like to have is just make sure you are doing a 20% down, because there is a thing called principal mortgage insurance, and that is a cost that you would be paying a lot of money to if you aren't able to put 20% down on a house. It's just like the bank or the lender's tricky way of saying, hey, we don't really trust you because you don't have a full 20%, but we still want to loan to you and make money off of all that interest. But we're going to tack on this thing called mortgage insurance, and so you would actually be paying more money and none of it goes to the principal of your house, so it kind of sucks, honestly. So make sure you can get enough down that you won't have mortgage insurance. Alright guys, once again, thanks for watching. I am all about personal finance, investing, helping you have more money at the end of the day. So if you're into any of those things, hit the subscribe button.